Will the China factor have an impact on our markets now?
So Chinese are not big investors in our equities. They prefer to invest in other markets. So that's not, their flows are not going to make any material impact. Second, China border skirmishes also, market is discounting that it will not explode, it will not escalate, it will not get blown into full war. If this assumption is wrong and we indeed have to fight a war with China, markets will correct. But if the skirmishes get settled through negotiation, markets will not have to worry about it. The third challenge from China is their dumping of goods. Fortunately, with import restrictions on cargo movement, China will not be able to dump their goods in India. Obviously, we have to keep on sure that this does not happen via smuggling also. The fourth important thing is companies coming out of China. Today, when world evaluates two oldest civilizations, one gave Wuhan virus, other is giving hydroxychloroquine tablet. One is denying that Wuhan virus originated at their end, but the second one is probably going to produce vaccine and supply to the rest of the world. Undoubtedly, compared to India, China is perceived negatively, and that will benefit in terms of more FDI and FPI flows to India. So China is an elephant. You will have to evaluate from different parameters to arrive at a conclusion on China.
Okay, so the second question is, you talked about gold. I think that was one of the questions that was been popping up with many people. Are there any other commodities other than gold that we can look at? Maybe currencies or some other, commodities that's available in the futures or whatever.
So I'm sure there are many commodities, but our knowledge is not there. We barely cover gold by talking to knowledgeable people and doing our own research. But on other commodities, you'll have to consult someone who is more knowledgeable than me.
Okay, fine, fantastic. So there are a lot of sectors right now which is being talked about. Of course, there are a little bit of challenges around IT. Between pharma, FMCG, which sector do you think it has got a much better growth prospect? Especially the fact that so many pharma stocks have really rallied up in the market recent times.
So what has happened is that pharma stocks were very, very cheap. For years, they were derated as their profitability came under pressure, and US FDA arbitrarily was stopping their factories. Now things have improved. US is interested in our hydroxychloroquine and other bulk drugs and other formulations. They are opening up factories. Factories are being run at full capacity by hiring contract labor. Pharma industries have done well in terms of performance, as it was one industry which was working all throughout COVID-19 era. On the other hand, FMCG industry was expensively valued, and it has gone further expensive. The difference between pharma and FMCG is return on equity. By and large, FMCG companies will be earning return on equity of upwards of 100% as they write off, despite writing off all the expenditure as revenue expenditure every year. On the other hand, many of the manufacturing companies have kind of leveraged their balance sheet. This is where the difference comes. Pharma stocks were cheap and now at fair value plus, FMCG stocks were expensive and they have become super expensive.
Okay.
If scenario is going to get worse from here, FMCG stocks will do well. There will be flight of safety. As they say, you don't lose your job by buying Hindustan Lever, even if it underperforms. In the good days, FMCG will outperform, in the bad days, FMCG will outperform pharma. In the good days, pharma has a better chance of outperformance over FMCG. So one will have to probably keep money in both the sector. Both are likely to outperform in market. My recommendation is to invest in both the sectors rather than choose one over another.
Okay, so the next is a very interesting question. After the reclassification in the mid cap, the amount of equity stocks available for mid-cap has considerably shrunk. So do you still think there will be a possibility to find attractive picks in the mid-cap sector?
I wouldn't agree that mid-cap space has shrunk. 1 to 100 are large caps, 101 to 250 are mid caps, 250 and above are small cap. So within the universe of 150 mid cap stocks, there is opportunity. More importantly, in mid cap funds, I have to put, if I remember correctly, only 65% in mid cap and 35% is allowed to be permitted outside of mid cap. So technically, that 65% of the portfolio has to be invested in this 150 stocks. That's a reasonable number, and we don't think industry classification, sector classification has resulted into any trouble for fund managers. If they were disciplined, if they were able to spot right opportunity and take corrective action, by and large, they should have been fine.
Okay, so your view on when do you think the auto sector will recover?
Auto sector, you'll have to divide it in 4 parts: two-wheelers, tractors, commercial vehicles, and passenger cars. Now, two-wheeler sector has started normalizing. Hero, TVS, Honda, Bajaj, they have all started their factory, and they are quite hopeful that they should be able to reach their previous year performance by next couple of months. In tractors, in the month of June, Mahindra and Mahindra had a record tractor sales, and last week averages of June and July were quite normalizing. Passenger cars, again, there has been a significant reduction in sales. Factories are producing at a much lower capacity utilization. And while buying of a car is not that large a decision like buying of a house, but it still involves emotional attachment from the family. One side, heart tells that maybe people will defer purchase of car. It doesn't matter whether you have a 5-year-old car or 7-year-old car. If it's running, it's good. On the other hand, the heart also says that people will prepone purchase of car, especially second and third for their family, because they would like their family members to avoid using public transport. Now, which of this hypothesis prevail, we have to see. I don't have data yet to suggest one over another. Commercial vehicles are down in the dump. All India Transport Motor Association has actually issued a circular saying that please don't buy new truck. We don't have ability to deploy. We don't have ability to operate. So if I look at auto sector, two-wheeler tractor will be the first to bounce back. And already M&M stock is, I think, up almost 100% year to date. After two-wheelers and tractors, entry-level motor cars should do well, and CV will take some time to recover.
Okay, thank you. The next one is, what is your take on telecom sector, especially in light of the fact that now you have one behemoth, one suffering, and another just being able to hold on?
So if you see in telecom sector, stocks have rallied significantly. Reliance Industries has rallied so much that Warren Buffett is now falling behind Mukesh Ambani. And as you very correctly mentioned, Reliance is behemoth dominating. Bharti is giving competition fighter. Voda Idea is in a precarious situation. So yesterday they did honor their commitment of 2,850 crore to bondholders. Despite rally of telecom stocks, they have remained firm. What is market discounting for telecom sector? One market is discounting that with 4 players left in the fray, Reliance, Bharti in better shape, Voda Idea, BSNL, MTNL in a tough shape, it is likely that average revenue per users will keep on improving. We should see ARPU moving from 150, 175 band to 250, 300 band over a period of time. If this trajectory of ARPU growth continues, telecom sector will be supported, otherwise not. Second, market is also pricing in that spectrum fees for 5G auction will be reasonable. People won't make the mistake of committing beyond what is there, what is good for them. They will not jeopardize banking their balance sheet in order to get license in this side. So if spectrum charges of 5G are okay, if ARPU continues to rise, telecom sector will continue to do well. If these two assumptions are not met, telecom sector will come down from current level. Monitor ARPU, monitor 5G auction. These are the two critical events.
Critical factors. Okay. So one of the other diversifications, is it okay to invest in funds which which invest in US stocks?
Definitely, one should put part of their portfolio in offshore funds. When I talked about gold, it was again with a view to give you international exposure. And US is a large market, developed market. Definitely, one should consider using index funds or fund of funds for taking exposure on US stocks.
In the same light, there is a little bit of attention that is coming to ESG funds right now, because there seems to be a greater awareness on environment and a whole lot of things. Do you think it makes sense to start off with some nibbling into ESG funds right now?
So if you look at ESG, that concept has come from the Western side, and post-COVID-19 focus on environment, social and governance will multiply manifold. Keeping that in mind, Kotak Mutual Fund became first signatory to United Nations Principle of Responsible Investing, UNPRI. And I'm happy to announce that all our portfolios meet UNPRI guidelines. And in Jan 21, we will be, be able to follow these guidelines in totality. ESG again is a very, very important concept to bring environmental concerns in your decision making, to reflect on social situation in your decision making, and most importantly, not commit any wrong move on the governance side. By and large, ESG stocks have created value for investors, as these are all the traits for becoming successful in business. If you are socially more responsible, if you are not taking shortcut on environment, if your governance is impeccable, market invariably rewards you by higher valuation, higher PE multiple. So ESG fund should be considered for investment by investors. It will be good to get a portfolio which also does well and which is also doing good to the society.
So the other very interesting question that's cropped up once again, discussed very often in media also, where do we stand in terms of attracting investments from companies which are perceivably thinking of shifting out of China?
See, in 1980, India and China were of similar size. Today, they are 5 times bigger than us. They became manufacturer to the world. We were left behind. Now, this is our opportunity to close gap with China by inviting companies to move out of China to be in India. Samsung has already shifted their mobile handset making plants from China to India. We need to replicate it across all the industry. World is hating China because of Wuhan virus. World is appreciating India because of hydroxychloroquine. There could not have been a better time than today to get companies out of China and bring them into India. So I'm quite hopeful that we will be able to get lion's share out of companies moving out of China. We'll be able to establish them in India with a red carpet rather than red tape. And that will create sustainable growth momentum for India for years to come, as this global multinational companies set up their large bases in India.
So there were two major initiatives by the government in the recent time. One was with respect to generating power from solar panels. The other was adoption of EV technology. In fact, they went on to the extent of even talking about having to ban combustion engines. Now, in light of the fact that both these initiatives have a fair bit of, dependence on China, how do you think going forward these two key initiatives of the government and a lot of, discussions on this is going to move forward, considering we are planning to put up some stiff tariffs against both these products?
See, Ishwar, today our trade deficit with China is about $49 billion. It was as high as $63 billion few years back. Now, can a country afford to let go $49 billion a year? That's just prohibitive. We need to be self-reliant in a manner where we are exporting more than we are importing. On oil, I have no control, I have to import. But do I have to import soft toys from China, apricot and almond and palm oil from rest of the world? Can we not make those things in India? When Durga Mata Murti or Ambaji Mata Murti comes from China, you have to ask your question, is it necessary? Now, it is extremely important for India today to be self-reliant by encouraging local entrepreneurs so that they can take on the world. When you encourage IT entrepreneurs, they have become globally competitive. Why not replicate the same in manufacturing? Why not have a 5 lakh worker textile company in India? Today, the largest textile company won't be employing that kind of manpower. This can only happen if that textile company is encouraged to consider the world as their market and they're taking necessary action. So for us, it is extremely important to encourage manufacturing by bringing multinational companies for foreign direct investment. Their technology and their investments will help create many sustainable business models. When Maruti came, you could see Mothers and Sumi getting created. We need to develop that across the industry.
Okay. So there are two more sectors which people wanted your opinion, your views on textile and transportation sector.
Textile, there is no one sector. You have spinners, you have fabric manufacturers, you have garment makers, you have specialty makers like curtains and so on and so forth. You have man-made versus natural, polyester versus cotton. You have competition between small scale versus composite, so power loom and handloom versus composite textile mills. In textile sector, one has to invest in companies which are non-leveraged, because leverage will become lethal in these days to come. And also you should be investing in those companies who has a sustainable business model or manufacturing model. A textile company using child labor versus a textile company not using child labor, you very well know which investor will pick up. A textile company polluting outside its factory premises versus one which is treating its waste resources and then releasing it into outside a factory, one exactly knows which investors will prefer. So within textiles, pick up your companies as long as they are non-leveraged, as long as their pollution management track record is exemplary. And most importantly, this is vertically integrated company rather than into piecemeal basis. If they're spinning fabric, garmenting capacity together, there's a better chance of their success rather than when they're individual spinner or fabric maker or garment maker. The second sector was?
The second sector was transport.
Transport. Again, there are very few listed companies in transport sector. We can't call aviation a transport, but I'm just including that for the sake of it. There's only 2 listed companies available in transport sector. You'll have to invest only in that company which can survive the downturn. in this downturn, many airline companies will shut. Second, if you go to logistics, there are companies which are involved into pure logistics. Some companies have very limited stock, 75% owned by promoter, balance 25% condemned by some large investors. Their PE is higher than Hindustan Lever. So I can't comment on investing on those stocks because they are expensive. But at the same time, the prices does not fall. In reality, there are some freight forwarders and delivery companies, but by and large, this transport and logistics sector has not delivered return to investors because of variety of things. In many cases, governance have been poor, and hence all the revenue does not come to the listed company. It gets taken away by many other places. So I will say between textiles and transport, try to stay away. It's far better to seek in many other companies better opportunity.
Okay, sir. The other, we'll just end with another 3 questions. We know you have a long stop at 6:25. What does the future hold for real estate and REITs?
In REITs, it's extremely important that underlying asset should be occupied. Now, majority of REITs are based on IT services company. TCS, Infosys, and everyone is announcing work from home. TCS set a target that 75% people will move to work from home. Now, they have about 400,000 staff. 75% is 300,000. Assume 150 square foot per person. 300,000 into 150, that's a supply which is very, very large. So invest in those REITs where underlying properties will remain tenanted, will produce rental yield, and will not remain vacant. If you believe that this is going to happen, then REIT should be invested. Otherwise, one should stay away. Real estate sector per se is one sector where governance is a big problem. They do all kinds of things in real estate sector which a normal investor will not like. So there are very few selective players which you can invest into. And my criteria in any sector right now is that stay away from leverage company. If a company is leveraged, he'll be finished and his equity shareholders will have to pay the price. The asset value will only go to the lenders. So try to stay away from leverage companies, stay away from textiles, transports and logistics, real estate and construction kind of companies, which are by and large generally leveraged and where governance practices are very poor.
Okay, so I can, you had a clear list of stayaways. Now, what is your view on Bitcoins?
See, ideally Bitcoin should be answered by a person who is no more than 25 years of age. At 52 years of age, I am eminently disqualified to answer Bitcoin. Bitcoin is again like COVID-19. We can't write, final word on it yet. It's an experience which are all going through. Now, in some sense, Bitcoin gives freedom to people to move out of their central bank regulation or government's ability to print infinite sums of money. But is it something which will be universally acceptable? I don't know. Is it something which can replace global currency system? I don't know. Today, Bitcoin is probably appreciating in value from whatever bottom it had made because it allows many investors to move their money below the radar of government agencies. That uniqueness probably helps attract many investors to invest into it. Treat Bitcoin as a marginal investment rather than principal investment. Put 3-5% of your portfolio with an intention that if I lose money, it's okay. If it works out, great. But as I mentioned, I'm not the right person to talk about Bitcoin. A 25-year-old kid will be far more knowledgeable about cryptocurrency than I am.
Okay, sir. So with this moratorium on, on the repayment of loans for MSMEs and others going to be lifted, how much more bloodbath do you see coming in both for banks and NBFCs? And what is your take on Yes Bank after these new issues?
So undoubtedly, as a deposit holder, you are safe in Yes Bank now, as it is owned by major banks of the country and government is fully behind it. As equity investors, I don't know, but the FPO which they have announced is at a very, very attractive price, substantial discount to market price. So maybe there is a flip-flop opportunity in Yes Bank, if not a long-term investment opportunity. In terms of moratorium, undoubtedly it disturbs credit culture, but it is necessary so that we can survive this current situation. My feeling is that moratorium impact will be different across different banks and NBFCs depending upon their credit culture. Today, the range of moratorium taken varies from 20% to 70% across banks and NBFCs. Clearly, the banks and NBFCs which are in 20% moratorium level are far better off compared to someone who is at 80% level. But my feeling is that with one-time restructuring of loans, we will be able to avoid material misimpact or adverse effect of moratorium. It is undoubtedly going to be there, but it will vary across banks and NBFCs.
At these turbulent times, what would be your advice for senior citizens?
One, do look at RBI bonds which has been issued on a floating rate basis. Earlier, they used to give 7.75% coupon on a fixed basis, but now they still, I think, give 7% plus on a floating rate basis. Second, there are some blue chip companies whose corporate fixed deposit is also providing reasonably good return in today's time. Please ensure that you don't go into any junk company because it's giving 2% extra return to broker or to you. Stay with very, very safe names like HDFC, Bajaj Finance, Mahindra, Tata, like that. This part of the portfolio should be able to take care of your daily requirement or monthly requirement of money. The other portion you have to invest looking at valuation of the market and your investment objective in riskier instruments like equity funds, like balanced funds, or like some of the volatile debt funds like dynamic bond fund or credit risk fund. The appreciation of equity funds, balanced funds, and dynamic bond funds or credit risk fund will allow you to outperform inflation, and the safety and anchoring of RBI bonds and corporate fixed deposit will allow you to get mental peace in terms of monthly cash flow, which takes care of your monthly expenditure. This combination will be appropriate for senior citizens.
Okay. Between S&P 500 stocks and Nifty, what's your take?
S&P 500 has outperformed Nifty by a significant margin. That's primarily driven by 5 or 6 FANG stocks and Tesla kind of things. My feeling is that it's not either or, it is both. You need to allocate to S&P 500 as well as Nifty. India as well as America, both are worth betting upon.
Fantastic. That's an excellent answer. The last question, and then we'll let you go. There's a lot of talk about index fund now. Now, our question is, as an active fund manager, do you think there will be an opportunity for fund managers to create a better performance and beat the index funds? Like, because US has been a case, people have been discussing that the index funds have been able to give a much better than managed funds. So both as the head of Kotak and the AMFI head, what is your take on fund managers being able to consistently beat index funds going forward?
Well, one, the market is cruel. If I don't outperform index, I will lose my job and I will lose you as my client. I don't have a choice. I have to deliver outperformance. Today, we are delivering outperformance, but sometimes it is getting missed. Index does not have cash. In fund, I have kept cash so that I can give you daily redemption. World over, index returns and fund returns are compared on a gross basis, where in index you calculate dividend yield. So total return index is compared with gross of expenses. In India, we compare net of expenses. Third, in index, globally, there is impact cost when a stock enters or goes out. In India, we don't have that. But you know, in portfolio, when you buy or sell stocks, you have to create an impact cost. So subject to impact cost, expenses, and cash, we are still generating positive alpha, though it may not be visible to you. But at the end of the day, I won't have a job if I'm not delivering value to my clients, and I won't be able to retain you. So for my survival, I have to generate alpha. I don't have a choice. The day I feel I can't generate alpha, I'll have to resign and move out.
Thank you, Nilesh Bhai, for the wonderful articulation of all the points. You have kept your end of your bargain by coming and giving us this wonderful insight. And we have kept our end of the bargain by just exactly finishing the meeting on dot and letting you go ahead with your other things. Thank you so much. It was such a pleasure having you over here. And it takes great pleasure to thank you on behalf of all the investors of PurplePond and all the well-wishers who have been part of this show. You have been your points have been direct, and it's well appreciated and received with a lot of gratitude. Thank you so much on being the show, sir. Thank you so much.
Thank you, Ishwar, and thank you, Sarvanan. Stay safe, stay healthy, and stay invested.
Thank you, sir.
Thank you
so much.
Bye.
Thank you, participants. Thank you. We'll be closing the window.